Welcome to today's video. In today's video, I'm going to be teaching you 3 chart patterns that make loads of money. If you're a Forex trader, you should know these 3 chart patterns. Yeah, boy. Because most other people are actually cashing out through these chart patterns. I'm going to be explaining it in detail as to how this chart pattern works, why it works, and how you too can also start cashing out with it. Let's head straight into this video. First, let me explain to you what chart patterns are. Chart patterns are basically the formation that candlesticks make whenever they are put into groups. So sometimes candlestick can tell you so many information by the way they are actually arranged in a particular instrument. When we have like about 3 candlesticks, 2 candlesticks, and 1 candlestick, we call that candlestick formation. But in chart pattern formation, candlesticks altogether can be about 5, 10, 15, can be so much that they get to form a pattern, a way that they look. So we have 2 categories of chart patterns. We have reversal chart patterns, and we also do have continuation chart patterns. Obviously, with the name, how it sounds, continuation chart patterns are chart pattern that you see and it tells you that this trend is about to continue. All right, and reversal chart patterns are chart pattern that you see at the top of a chart or at the bottom of a chart, telling you that at the bottom, oh, the sellers are getting tired, now it's about to be buy time, it's about to be bullish. Or at the top, the buyers are getting tired, now it's about to be a bearish trend. Like that, these are the 2 main categories. But today, I want to explain to you the 3 ultimate ones that traders have been using to cash out that you probably have not been exploring well enough. Let me explain. So the first one I'm going to be explaining is double top. Double top is a chart pattern that happens most of the time on GBP USD. It also happens so many times on Euro USD, GBP, JPY, all this normal casual pair that everyone trade on a day-to-day basis. So you should know about it. So right on my screen, check. We have candles first forming a high, and then a couple of other candles came in, went for a sell first, and then we had another bullish actions, making you feel that it wasn't even going to sell, and then get to this about the same high. Sometimes the second high might be higher than the first one. So we are going to call this one the first high, and then this is going to be the second high. Sometimes the first high can be higher than the second one, and vice versa. It's in a rare occasion you find out that they are equal, like this one. They are equal. So what this states is that the buyers, the psychology behind it is the buyers were able to push price up to this resistance point, but it was rejected by sellers. Thereby, these first sellers that got in took their profit here, or they exited the market, thereby forming a buy pressure. Then it moved straight up, came back and formed at the same resistance point. Price got rejected off of that zone. So anytime that you see double top, okay, immediately you opt in for a sell after a sell, a bearish candle confirmation, just such as this one that we have right here. Immediately you see this, you get in, and then you have to put your stop loss a little bit above the recent high that was created by the first leg. In a case where the second leg is higher, that happens, thereby creating divergence, then you have to look for the last high or the previous high that is higher than the second leg, and then you put your stop loss a little bit above that. Or that's in a rare occasion. So that's how to trade double tops and double bottom. So double top is for a sell example, double bottom is for a buy example. So you can see double bottom here too as well. So you can see first leg and second leg forming in form of W. So these are patterns that we could also invert, and we could also call them a W and M because it comes in form of those 2 alphabets. So now let me just look for the brush 2 and then from you see how it works. You see, it went up. After going up, you're not gonna buy yet. You wait for it to exhaust and form almost an equal low with this, and from here, boom, candle takes off. But a more safer way to trade this is you have to wait for a bearish, or in this case bullish confirmation. So a bullish confirmation candle is this first bull that went in your direction. After this candle closes, already you should have thought that this is the first leg and this is already the second leg. So from here you should be getting in. So you should be getting an entry point from here. So as with the other one too, so if you have to wait for this bearish confirmation, either you wait for this one or you probably wouldn't have known then, or you can just wait for this one, and from on the close of that candle, but this you would have already been scared that this is looking extended, then you just go in for a sell right here. But you see, it still does work. Even if you have put your stop loss right here, you still see that you make profit for a longer period of time. So that is the double top and double bottom candlestick chart pattern. The next candlestick pattern that everyone loves to trade, or whenever they see it, you see, or the whole groups, everybody is saying, oh, it's what we call head and shoulder pattern. The opposite of that is inverse head and shoulder pattern. So I'm just going to be treating one, and then you already see it. If you see it in the opposite side, you know what. Oh, Jeffrey talked about this sometime in his YouTube. So on the screen, you can see that we have a head and shoulder, but this is inverse. If it's found, when you see it at the bottom, it's called inverse. If it's at the top, it's just head and shoulder. So, but this is inverse. So you just inverse this example for the opposite one. So head and shoulder pattern is a pattern that you find at the end of a trend. So it's a reversal chart pattern, just like the way we have double top. It's also a reversal chart pattern. So anytime you see a head and shoulder, just know that the trend is about to change. If it's inverse, the bearish trend is about to change to bullish trend. If you find it, if it's head and shoulder, you know that the bullish trend is about to turn to a bearish trend. How does it work? This pattern tells you a lot about momentum, pressure, and everything. So first, we have a very strong bearish move that is imminent, and then it retraces a little bit. All right, touches the neckline. This is a support. This is a resistance rather. Then from there, it drops again, forms a lower low. So that lower low is termed a head. All right. So this first point of hesitation is what we call a left shoulder, LS. And then it moves up a little bit and hesitates again. It does a drop back before it starts going up. So this point of hesitation again is what we call a right shoulder. All right, right shoulder from this point, then it starts going up. And you'd notice that we have a neckline somewhere around here. Neckline is where there was a previous resistance, previous rejection, and the price also got there rejected. So the best way to trade a head and shoulder sometimes is you have to wait for this neckline to be taken off. This is what's called neckline, all right? Neckline. So immediately get taken off, retest. From here, you should have a buy action. That's how the concept of these head and shoulder works. Inverse head and shoulder, they are very active chart patterns that most people do take advantage of. Anytime you see it, it means that the candlestick, that your signal is going to go. You are in to catch anytime you see it, that means that you are in to catch a very long ride of pips, a lot of pips, because it's a reversal chart pattern. So if you're able to catch it so well, you'll be able to make a lot of money. Third one I'm going to be discussing here is bullish rising wedge. The opposite of that is bearish falling wedge. So I tried looking for it on USD GBP USD. It's not. I tried looking for it on GBP USD. I found out that it barely happens here. So do you know what I did? I searched other pairs. I know that it happened most on USD JPY. So that's why I'm going to be switching from here to USD JPY, just so I can show you how it looks, and then you'll be able to identify it when you see it on your own. Everything that we teach you is all about independence. You have to learn how to spot these things on your own. So that's why you don't take my YouTube videos for granted. So if you're new here, make sure you hit the subscribe button and like this video so it can be recommended to other people that will be interested to also learn the same things. So talking about the bearish wedge, falling wedge. So first thing you're always going to see is it looks like a triangle, but that is headed like it's rising up, but then it's closing in. You see how it's rising up, but then it looks and it's closing in here. So that's how this bearish falling wedge looks. So anytime that this you can even just simply just do like reversal chart patterns for you to see these things. But I'm just giving you a very good insight on how it does really works. How it does really work. Check this one. So you see, we're having a bearish rising wedge. This is the one we're treating right now. This is a bearish rising wedge, and it's what we found on USD JPY. A bearish. Is it bearish? Yeah, it connotes bearish rising wedge. It means it's going to drop, and then this is bullish falling wedge. Okay, so immediately price gets to, first we have a low, and we have a low, and then have another one again, a touch up and high and high. Then if price breaks out of this trend line that is here, it shows that the weakness is already setting in. First we have a preceding uptrend. It's found at the top of the trend. Immediately price get here is showing that the buyers are getting exhausted, most of the time you can easily use to spot this is, you know this by candles strength and weakness. Candles weakness. The bullish are really hesitating to push price up, and then whenever the bears come, it's also about the same amount of space that the bullish candle also covers. They just start forming like consolidation, but at the end of the day, the consolidation is sort of still tilted upside. All right, so then you're going to look for highs, and highs. You're going to draw a candle, a trend line in there. You look for lows, and draw a trend line in there. So anytime you find that there's a breakout to the downside, like we have here, this breakout that we have here, then immediately you go in for short for price to drop you down there. So there are a couple of other examples, but mainly they are found on USD CAD, USD JPY, all those pairs that they are really so trending in one direction, and then they come before they reverses, they're always very choppy, and it takes time. So these are the kind of pairs that you can easily find this bearish rising wedge. All right, so these are the candlestick patterns that I have for you, and I hope you guys found value in this video. If you do find value, do make sure to subscribe to my channel, and I always drop loads and loads of content like this and even other ones. All right, if you want live trading video, make sure you join me every Monday where we trade live, and fund the account, join me, then we'll get to trade live. I've got a Telegram channel you want to be a part of. Use the link in the comment section or in the description box to be a part of that, and I'll see you guys some other time. Bye for now.